Hi guys, this is Sia Jane and welcome back to my channel ACCA and Beyond. And let's continue with our revision series of audit and assurance. So our next chapter is going to be chapter number 6, which is planning. Again, I'm not going to be able to cover the whole chapter in one video, so I'm again going to divide it into two videos. So just look out for that. Okay, let's begin. Okay, so the objective of the auditor as per ISA 300 is to plan the audit so that it is performed in an effective manner. Now, audits are not simple process. They can be complex, risky, and expensive. Even though firms have standard procedures and manuals, proper planning is still essential for every audit engagement. Planning helps the auditor to focus on important areas of the audit. This means more attention is given to high risk areas where misstatements are more likely. It also helps identify and resolve potential problems early before they become bigger issues during the audit. Planning allows the audit to be organized and managed in an efficient and structured way. It also ensures that the right team members are selected with the appropriate skills and experience for the engagement. In addition, planning helps in directing and supervising the auditing and reviewing the work performed. It also allows better coordination with other members, with others such as experts or internal auditors. Overall, proper planning reduces the risk of a poor quality audit and helps ensure that the auditor gives the correct audit opinion. Okay. Uh, in order to achieve the overall objectives of the auditor, the audit must be conducted in accordance with ISAs. This ensures that the auditor is fulfilling all of their responsibilities properly. It also means that the users can rely on the auditor's opinion in the same way as another, creating consistency and trust in audited financial statements. Following ISAs also helps maintain a high standard of audit quality globally and protects the reputation of the profession. In addition, ISAs provide a benchmark to assess the quality of an auditor's work. But Okay, so now auditors must also apply professional skepticism, which we have covered earlier. But just have a questioning mind is not enough. The auditors must also apply professional judgment. Professional judgment means using training, knowledge, and experience to make appropriate decisions during the audit. So, a risk based audit approach requires skills, experience, and an inquiring mindset. Also, even though risk assessment is done with during planning, new risks can arise at any stage of the audit. So, audit procedures must be updated whenever new risks are identified. This is usually overseen by the engagement partner who ensures the audit approach is adjusted when required. Now, the planning process itself has multiple elements. Begins with the preliminary engagement activities. These include deciding whether to accept or continue with the client, ensuring compliance with ethical requirements, and confirming that there are no misunderstandings about the terms of the engagement. Planning activities include developing the strategy and the audit plan. Before the audit strategy and audit plan must be properly documented, and any changes made during the audit must now also be recorded. Now, the audit strategy. The audit strategy sets the overall scope, timing, and direction of the audit. In simple terms, it provides a high level plan uh, of how the audit will be carried out. It helps the auditor decide what resources are needed for different areas of the audit. This could include assigning experienced team members or even using experts for complex areas. It also determines how many resources are required, meaning how large the audit team should be. The strategy also considers whether these resources will be used during the audit. Finally, it sets out the team will be directed and supervised, including meetings, reviews, and overall coordination. Once the audit strategy has been established, the next step is to develop the audit plan. The audit plan is more detailed and explains how the overall strategy will actually be carried out in practice. So it is more detailed. It translates the strategy into specific actions for the audit team. The audit plan includes details about the direction, supervision, and review of the audit team's work. This ensures that work is properly guided and checked on different stages of the audit. It also sets out the nature, timing, and extent of risk assessment procedures. In addition, it includes details of further audit procedures. This means clearly specifying what procedures will be performed, who will perform them, and how much work is required, and when will the work be carried out. For example, whether procedures will be done at the interim stage or at the final audit stage. The audit plan must also include any additional procedures required to ensure compliance with ISAs. Overall, the audit plan ensures that the audit is carried out in a structured, detailed, and a well coordinated manner. Okay. The auditor also considers the timing of audit procedures. This includes deciding whether to perform an interim audit, a final audit, or only a final audit. An interim audit is usually carried out when the client is large enough to justify the additional cost. Although it may increase cost, it helps improve risk assessment and makes the final audit more efficient. It's important to understand the interim and final audit are not separate audits. They are simply two stages of the same audit with one set of financial statements and one audit report. The work is just split into two phases, some before the year end and some after. Sorry, 1 second. Yes. Now, interim audit. This is performed during the accounting year before the year end. It is timed so that it does not interfere with the client's year end processes, but it is still late enough to allow meaningful work to be done. The main purpose is to spread out audit work and identify any issue early on, so they can be addressed before the final audit. Now, about the final audit. This takes place after the year end at a time agreed with the client. The timing should allow the client to meet reporting deadlines without disruption. Auditors usually avoid working during the actual year end period to prevent interference with the client's operations. The purpose of the final audit is to obtain sufficient appropriate evidence on the financial statements. Once this is complete, the auditor issues the audit report, which marks the end of the audit. Now, let's look at the work performed during interim and final audits. During the interim audit, the auditor typically focuses on documenting systems and evaluating internal controls. This helps the auditor understand how the business operates and whether the controls are working efficiently and effectively. Additional work can also be done at this stage. For example, testing specific material transactions such as the purchases of non-current assets. The auditor may also test transactions like sales, purchases, and payroll for the year to date. This assessment is also updated so the auditor can plan better for the final audit. In some cases, the auditor may attend perpetual inventory counts during the year. Now, moving to the final audit. At this stage, the auditor focuses on the areas that can only be assessed after the year end. This includes auditing statement of financial position balances. The auditor will also test transactions that occurred after the interim audit. Year-end journals are tested, including any adjustment made to earlier transactions. The auditor must also confirm that the controls tested during the interim stage have continued to operate effectively. Finally, completion procedures are performed. This includes reviewing going concern subsequent events, performing an overall review of the financial statements, and communicating any misstatements to management. Now, the impact of interim and final audit. If controls tested at the interim stage are effective, the auditor can reduce the extent of substantive testing at the final stage. If substantive procedures are already performed during the interim audit, less work will be needed later, making the final audit quicker and more efficient. This also allows the audit report to be issued sooner than after the year end. However, if issues are identified during the interim audit, such as weak controls, then more detailed testing will be required at the final audit. Misstatements in financial statement can arise from either fraud or error. The key difference between the two is intent. Uh, if the misstatement is intentional, it is fraud. If it is unintentional, it is an error. Now, let's talk about fraud. Fraud is an intentional act involving deception carried out by management, employees, or even third parties to gain an unfair or illegal advantage. There are two main types of fraud. First is the fraudulent financial reporting, and second is misappropriation. In fraudulent financial reporting, it involves deliberately misstating the financial statements to make the company's performance or position look better or worse than it actually is. In second, misappropriation of assets. This refers to theft of company assets such as cash or inventory. Now, about error. An error is an unintentional misstatement in the financial statements. This could include mistakes in collecting or processing data used to prepare the financial statements. It may also arise from incorrect accounting estimates due to oversight or misunderstanding. Errors can also occur when accounting principles are applied incorrectly, such as measurement, recognition, classification, or disclosure. The primary responsibility of preventing and detecting fraud lies with the management and those charged with governance. It is not the auditor's responsibility to prevent fraud. That responsibility stays with the company. This is achieved by implementing strong internal controls. Effective controls reduce the opportunity for fraud and increases the chance of detecting it. In addition, creating a culture of honesty and ethical behavior is very important. Active oversight by those charged with governance also helps reduce fraud risk. Directors must be aware of fraud risks and include them in their risk assessment and corporate governance processes. The audit committee plays a key role by reviewing these procedures to ensure they are properly designed and working effectively. This is often supported by the internal audit function. Now, about internal auditors. Internal auditors help management in preventing and detecting fraud and error. They test the effectiveness of internal controls and recommend improvements where needed. They may also carry out fraud investigations to identify how the fraud happened, its extent, and how to prevent it in the future. In addition, they can perform surprise checks such as asset counts to detect misappropriation. The presence of an internal audit function itself can act as a deterrent as employees know there is a higher chance of being caught. Now about external auditors. The auditor's role is not to prevent fraud but to assess the risk of materials misstatement in the financial statements due to the fraud. When assessing the risk of fraud, the auditor must obtain reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. The auditor must also apply professional skepticism and remain alert to the possibility of fraud at all times. This means that the auditor should not rely too much on past experiences with the client, even if management has previously been honest. Fraud can still occur, and the auditor must always consider the risk. The auditor must also recognize that management may override controls. This is important because procedures that detect errors may not always detect fraud. To assess fraud risk, the auditors perform several procedures. First, the engagement team discusses how financial statements could be susceptible to fraud. This includes considering incentives such as bonuses or pressure to obtain finance. It also includes opportunities such as weak internal controls and management attitudes such as conflict with auditors or failures to correct known issues. The auditor will also inquire with management about how they identify and respond to fraud risk. In addition, inquiries are made with internal auditors and TCWG to check if they are aware of any actual or suspected fraud. Analytical procedures are also used to identify unusual relationships or trends that may indicate fraud. Now, responding to fraud risk. The auditor must review journal entries to identify possible manipulation or unauthorized adjustments. This includes asking management about unusual journal activity and focusing on entries made at the end of the reporting period. The auditor must also review management estimates for any signs of bias. This involves evaluating whether the judgments are made by management are reasonable. The auditor should also perform a retrospective review of prior estimates to see if there is a pattern of bias. Next, the auditors review unusual transactions. These include transactions outside the normal course of the business or those that appear unusual. Such transactions may indicate fraudulent financial reporting and must be carefully assessed. The auditor must also obtain written representations from management and TCWG. These confirm that management accepts responsibility for internal controls to prevent and detect fraud. They must also confirm that all known or suspected frauds and the results of their fraud risk assessment have been disclosed to the auditor. However, even with proper planning, there is always a risk that some material misstatements may not be detected. This is because fraud is often concealed, sometimes involving collusion or senior management. The likelihood of detection depends on factors like the skill of the fraudster, the size of the fraud, and the level of authority involved. Now, reporting of fraud and error. If the auditor identifies fraud, it must be reported promptly to the appropriate level of management. If management is involved, the matter must be reported to TCWG. If there are concerns about their integrity, the auditor should seek legal advice. The auditor must may also have a responsibility to report fraud to external parties depending on on legal requirements. Although confidentiality is important, legal obligations always override this. So legal advice should be taken where necessary. If fraud has a material impact on the financial statements, the audit opinion will be modified. When this happens, the auditor will clearly explain the reason for the modification of the audit report. This ensures that shareholders are made aware of the issue. Uh, so we'll move on. So, non compliance refers to acts either intentional or unintentional that go against laws or regulations. This includes actions by the entity but does not include personal misconduct unrelated to business activities. Now, responsibilities of management. Management, along with TCWG, is responsible for ensuring that the entity complies with relevant laws and regulations. Uh, this includes laws that affect the amounts and disclosure in the financial statements. Now, responsibilities of the auditor. The auditor must perform procedures to identify any non compliance that could have a material impact on the financial statements. The auditor must also obtain sufficient appropriate evidence regarding compliance with laws that directly affect financial statement amounts and disclosures. For example, this could include compliance with tax laws when calculating tax provisions or proper presentation of financial statements according to the applicable framework. The auditor must also consider non compliance with other laws and regulations. These may not directly affect financial statement amounts but can still have a material impact. Examples include data protection laws, environmental regulations, and health and safety requirements. Non compliance in these areas could lead to penalties, legal liabilities, or even affect the company's ability to continue as a going concern. Okay, so let's talk about the audit procedures to identify non compliance. The auditor should first obtain a general understanding of the legal and regulatory framework applicable to the entity and its industry. They should then inquire with management and TCWG about whether the entity is complying with these laws. The auditor may also inspect correspondence with regulatory authorities for any indications of non compliance. Written representations are also obtained from management, confirming they all known cases of non compliance have been disclosed. They must understand the nature of the issue and the circumstances in which it occurred. They should then obtain further information to assess the possible impact of the financial statements. If non compliance is identified, further procedures are required. This includes discussing penalties with management, reviewing correspondence with regulators, and checking board minute for discussions on how these issues have been handled. Now, about reporting non compliance. The auditor must report any identified non compliance to management and those charged with governance unless prohibited by law or regulation. If the non compliance is intentional and material, it must be reported directly to TCWG. If management or TCWG are themselves involved, the matter should be escalated to the audit committee or supervisory board. If the non compliance has a material impact on the financial statements, the auditor will need to modify the audit opinion, such as issuing a qualified or adverse opinion. The auditor must also consider whether there is a legal or ethical duty to report the matters to external parties, such as regulators. Now, responding to non compliance, also known as no CLAR. Yeah. Ethical guidance requires auditors to get act in the public interest when dealing with such situations. This guidance has introduced because confidentiality was sometimes preventing important issues from being reported. As a result, serious non-compliance would go unaddressed. When responding to non-compliance, the auditor must follow the principles of integrity and professional behavior. They should first inform management or TCWG so they can take action to correct or prevent the issue. If necessary, the auditors must take further action in the public interest. The overall aim is to ensure that issues are identified and addressed early, and that appropriate action is taken to protect stakeholders and the public. Certain matters relating to non-compliance must be properly documented. This includes the nature of the issue itself. It also includes the result of discussions with management and TCWG. The auditor must document how their superior responded to the matter. In addition, all actions considered, judgments are made, and decisions taken must be clearly recorded. Now, about quality management. ISA 220 requires audit firms to design and operate a system of quality management. The aim is to provide reasonable assurance that audit is conducted in accordance with professional standards and legal requirements. It also ensures that the audit reports are issued and are appropriate in the circumstances. To achieve this, firms must establish policies and procedures in the key areas. These include leadership responsibilities for maintaining audit quality. They must also ensure compliance with ethical requirements. Procedures must be in place for accepting and continuing client relationship. The firm must ensure it has appropriate resources for each engagement. This includes having competent staff and sufficient time. There must also be controls over how the audit is performed, along with monitoring and corrective actions where needed. Overall, quality management ensures consistency, reliability, and high standards in audit work. The audit and assurance syllabus requires an understanding of key areas of quality management. These include ethical requirements, engagement resources, engagement performance, and monitoring and redemption. Now, ISA 220 revised focus on improving audit quality. It encourages proactive management of quality at the engagement level. It also emphasizes the importance of professional skepticism throughout the audit. Another key focus is better documentation of the auditor's judgments. Overall, the standard is designed to remain effective even in complex and changing environments. Um, Now, relevant ethical standards. The firm must ensure compliance with the ACCA Code of Ethics and Conduct. The engagement partner has a key responsibility here. They must identify, evaluate, and address any ethical threats. They must also remain alert throughout the audit for any breaches of ethical requirements. If any issue arises, appropriate action must be taken immediately. Before signing the audit report, the engagement partner must confirm they have all ethical that all ethical requirements have been complied with. Now, engagement resources. The engagement partner must ensure that sufficient and appropriate resources are assigned to the audit. This includes having the right people with the right skills and experience. It also includes having adequate technological resources to support the audit work. Human resources are a key part of engagement resource. The audit team, along with any external experts and internal auditors, um, providing assistance, must be competent and capable. This means they must have the right skills and knowledge to perform the audit effectively. Competence includes practical experience and a good understanding of professional standards. It also includes expertise in specialized areas such as complex accounting or auditing issues. In today's environment, knowledge of IT systems and data analytic tools is also important. The team should also have an understanding of the client's industry. In addition, they must be able to apply professional skepticism and judgment throughout the audit. They should also be familiar with the firm's policies and procedures. Now, if sufficient resources are not available, the auditor must take action. This could include changing the audit approach to reflect the limitations. The auditor must also request an extension to the reporting deadline. If necessary, they can follow internal procedures to resolve issues or disagreements. In extreme cases, the auditor may even withdraw from the engagement. Okay, sorry. Yeah, let's continue. Now, technological resources. These include tools used for communication meetings and automated audit techniques. For example, audit softwares and data analytical tools. When these tools improve efficiency, the auditor must be careful not to rely on them too heavily. Professional judgment is still essential. Next, intellectual resources. These include audit method these include audit methodologies, guidance manuals, templates, and checklists. They help ensure consistency and how audits are performed and support compliance with professional standards. Now, engagement performance. This refers to how the audit is actually carried out. It includes direction, supervision, and review of the audit work. Direction means auditing, guiding the audit team and clearly communicating with responsibilities. Team members must contribute to maintaining audit quality and apply professional skepticism throughout the engagement. Team members are required to perform audit procedures as planned. More experienced members are responsible for directing, supervising, and reviewing the work of junior staff. Each member must clearly understand the objectives of the work they are performing. They must also ensure that audit quality is not compromised due to pressures like tight budgets or limited resources. Let's move on to supervision now. Supervision involves monitoring the progress of the audit to ensure that objectives are being achieved. It also ensures that sufficient and appropriate resources are available throughout the engagement. If issue arises, the audit approach may need to be modified. For example, more complex areas may be reassigned to more experienced team members. Supervision also includes identifying when consultation is required, especially in areas where the firm lacks expertise. In addition, it involves providing guidance and coaching to help develop the team skills. Finally, it is important to create an environment where team members feel comfortable raising concerns without fear. Now, let's review responsibilities. Um, the reviewer must ensure that the audit work has been performed in accordance with professional standards and firm policies. They must also check whether appropriate consultations have taken place where required. The reviewer evaluates whether work performed actually supports the conclusion reached. They must also confirm that sufficient and appropriate audit evidence has been obtained to support the auditor's report. Finally, they assess whether the objectives of the audit procedures have been achieved. The engagement partner also plays an important role in reviewing audit documentation. This includes reviewing key areas such as significant matters, important judgments, and other critical aspects of the audit. Now, about engagement quality reviews. An EQR is an independent evaluation of the significant judgments made by the audit team and the conclusion reached. This review is performed by a separate individual known as the engagement quality reviewer. Oh, sorry, I underlined the wrong text. Yeah, so they are known as engagement quality reviewer. This person can be a partner, another qualified individual within the firm, or even an external reviewer. EQR is typically required for listed entities and other high risk clients. This include public interest entities or clients with complex or unusual risk. For such engagements, the engagement partner must ensure that an EQR is carried out. They must cooperate with the reviewer and ensure that the audit team does the same. All significant matters and judgment must be discussed with the reviewer. Importantly, the auditor report cannot be signed until the engagement quality review is complete. Now, the eligibility of the engagement quality reviewer. The reviewer must not be part of the engagement team, obviously. They must have the required competence, experience, and sufficient time to perform review effectively. They must also have the appropriate authority and comply with all ethical and legal requirements. Now, monitoring and remediation. Firms must establish a system to monitor the quality of the audits and identify any weaknesses. This system should provide reliable and timely information about how well quality management processes are working. To achieve this, the firms must set first clear quality objectives, then identify and assess risks that could affect audit quality. Finally, design and implement responses to address those risks. The firm must monitor the system as a whole. This includes reviewing complete audit engagements, especially those selected based on risk. If deficiencies are identified, the firm must assess how serious they are and investigate the root cause. The impact of these deficiencies on the overall system must be evaluated. Once this is done, appropriate corrective actions must be taken. For example, this could include involving experts or increasing supervision and review. If deficiency does not affect audit quality, no further action may be required. Also, identifying a deficiency does not automatically mean the audit opinion was wrong. Finally, firms are required to carry out an annual evaluation of their quality management system. So, for this video, I'm going to stop here because if I make long videos, my it just doesn't get stored properly and the video starts lagging. So I'm going to stop here for today. I really hope you found this video useful, and if you did, please do like, share, and subscribe, and share it with your friends. Thank you so much for watching.